do is the chapter 3 practice exam. Okay. So let's take a look here. Okay, so we're buying this investment. You bought all of them, so we're buying all 100% of Bill Company's outstanding stock, and we're doing that by exchanging some of our stock for it. Okay, so let's take a look here. That was done on January 1st. And we're gonna have the investment account. Actually, I'm gonna peek ahead because I want to make sure that I have them the same. What do we call it? Oh, we just call it investment. Okay, I'll put a little extra on here. And I don't know the price just yet, but we issued stock for it. 10,000 shares of stock. By the way, this is an asset going up. This is equity going up. And let's see, we had 4,000, no, we had 10,000 shares with a $4 par value. What happened here? Okay. And that equals 40,000. Oops. Try that again. Let's try that a third time. Put in the right column, how about? Okay, so here's our common stock. And then we're gonna have additional paid in capital. I don't know why this row is higher than the rest of them. Anyway, doesn't matter. So additional paid in capital, I'm just gonna call it APIC. Also an equity account going up. And it's gonna be the excess. So the excess over par, additional paid in capital over par. So 1485 minus 4 times 10,000. Can't remember how I did this before. Oops. Times 1485 Oops. Take the Q out. Okay, so the additional would be the 10,000 times 1485 minus 5, so was that 10.85, $10.85. Okay, so this would be. Well, 108,500. And that would be the investment, those two together. Oops. All right, so this is our investment. Oh, I spelled dividends wrong, I think. Oopsie daisy. Okay, so company's dividends. Now you'll remember, these are paid out on 12/31/2025. Okay, so dividends, so we got cash. Going up. $3,300. And now remember, we're using the equity method here. So this would be. Asset going down. Now, if you're wondering, we're not multiplying it by, 10% or 20% or whatever, because we own all of it. We own 100% of it. So if you're wondering why we're not taking 10, 20% or whatever, it's because we own all of it. So when they pay us, we don't feel any richer. We say, okay, well, we got 3,300 more in cash, but now this investment is worth $3,300 less. Come down here to income. Income is virtually always done at the end of the year. It can be done quarterly too, but there's only been an ending income amount. And that will increase our investment. Asset going up. 13,200. I'm going to cheat and look ahead and see what they call that. Equity and, okay, we'll use this term, equity and investment income. If you just call it investment income, that's fine. I think that's what we called it before. Okay, so this would be going up by 13,200. Okay, now coming up here, it's possible we have goodwill. Actually, I know we do, but it's not in here. We don't need it for this yet. Excuse me, I'm boring myself. Okay, hang in there, Mark. Don't black out just because you're boring. Okay, so infinite life, we don't have to do anything to that. We do need a little more depreciation here though, because, hey, what happened? We have 50,200 excess value in buildings and it's gonna last for 10 years. So divide by 10, comes out to $1,320. Additional expense. Okay. So we'll make it green. All right, so this is let's bold the whole thing and make the whole thing green. Okay. Okay, so we got to take that out of our income. And it needs to come out of our investment consolidated asset because it's, hey, how come I didn't space over? Gonna reduce it. So again, this is kind of, if you remember back, way back 3 weeks ago, you remember that when you were doing the equity method, and that's usually the method that we will use, is the equity method. So it's right here, use the equity method. Which is commonly what you would use on it. And this is one of those things that in the book, they say something's kind of crazy and they say that sometimes they won't make journal entries for as if they didn't make any journal entries for the subsidiary. But if you think about it, it's kind of nutty because if they're sending out dividends, you can't just have a one-sided dividend entry. You have to have something to go up against it. So usually they have they'll be doing the equity method is pretty common. Okay. Yeah, so this would be what it would look like. Okay, so this actually feeds into this down here. This is the same problem. But now we're going to consolidate the entry. So during the year, this is what we would do. Make the regular journal entries. I'm gonna do something here. I just want to check and make sure that we got the right numbers in here. 148,500. Let's put this on the side here. No, let's do somewhere else. Oh, I know what I was gonna do. And what's what I'm gonna tell you. We can actually do this. I'm gonna do this in there's actually for the practice exam problem too, there's an Excel. You can do it in Excel if you want. But I want to check something here just to make sure these match up. Oh, where am I at? I just want to make sure 148. I'm gonna put it over here on the side. I'll make sure the investment adds up to the same. 8,500 plus, no, minus 3,300 plus 13,200 minus 1320. Hopefully this comes out to, no, it doesn't. Why not? We're in trouble. I did something wrong. Darn it. Set off by 680. How can that be? 660. I think something might be wrong here. Darn it. Eh. Well, we'll go through and see what happens. 148,500. Dividends are 3,300. I got the wrong income. Okay. Now I'm embarrassed. Let me see. So 13. Is that right? Okay, this should be 13,860 apparently. That would be it. Okay, well, on the test, let me make the correction over here. 13,860. And I promise on the test, I will check, double check, make sure that that is correct. Oh, look at that. I had it here. 13. I just entered it wrong. Hey, how come you guys didn't tell me I'm doing something stupid here? It should have been 18th or 13,860. See, it says it right here. I somehow grabbed the excess value here. You guys, come on. You gotta say, hey, Mr. Taylor, you're being stupid again. Okay, well, found the error. So 13,860. Make sure you change this. So C on the first page, make sure you change that. So this is the correct. Oops. I mean, I'm even writing correct and correct. Correct. Okay, so 13,860. So this is right. It's just I'm wrong. My journal entry. Okay, well that's better than I guess being with the handout scooped up. Okay, so this is 157.74. Okay, so this does work out. Yay. Okay, well, so let's take a look up here. We got to figure out the net assets at fair value. All right, so we're going to take the assets at fair value minus the liabilities at fair value. And this will get our net net identifiable assets at fair value. Okay, so how much goodwill do we have? This shouldn't say cash price paid. This should say to say consideration. Because we actually didn't give cash, we gave them consideration. We gave stock. So how much goodwill do we have? Anyone? Oh, come on, you guys are toying with me. Okay, I apologize for making the mistake on the journal entry. Anyone? You guys are sleeping, aren't you? I'm gonna wake you up. Oh, come on, someone has to be listening. Nobody? Nobody's listening? Here I am freezing to death in classroom Alaska. All
Is
right.
it 59,400?
No, you're gonna take the consideration that 148 minus that. But thank you for chiming in. Thanks. So
$16.
listen, I'm sorry.
I came up with $16.
Yeah, 16,500, I think. Oh, here, I'll do it here. Oops. When I came here to class, there was already people in here and they're like, oh, I was like, maybe I should go to a different classroom that actually has heat. Leave them in here, but I thought, oh, you guys, okay, so the goodwill would be, let me just draw some arrows in here. Just to make it a little more confusing, we'll draw some arrows here. Of course, the light blue. I do want to find out who did that. Okay, so we got that, and let's make a copy of that. So we have identifiable assets, which is kind of a funny term, but we have the identifiable assets of 132. And the goodwill, the new terminology, I guess, is that is unidentified. So 16,500 goodwill. Okay, I think we're ready to start going, aren't we? I think so. Okay. Well, let's get rid of this investment. We don't want to count it twice. Excuse me. And you'll recall that this is the same investment as we just did over here. This is the exact same investment. During the year, we made these journal entries. So when we get to the end, I didn't have erased it, but that get rid of this. Oh, wait, I see it for the income. Okay. All right, so we got to get rid of the thing. So we're gonna start out with our Sadie. So we got to get rid of the stock. Okay, so stock, we gotta get rid of the stock. So we'll say S, and we will have to go to the beginning for the retained earnings on this. What happened? I meant to do. There we go. All right, let's make this orange. And we got to go all the way back to the beginning retained earnings to take that off. Excuse me. Okay. Let's see here. $112,200. Next, we got to go to the assets. And the assets, we have 6,600 in land and 13,200 in building. Okay, so land. Building. And the one that I always forget. Ooh, I changed the spot on it. I changed the location on it, but there's one I always forget. What is it?
Goodwill.
Goodwill. Yep. There's other ones I always forget too, but Goodwill is one. So I'm gonna plug in the Goodwill. And notice it's in a little bit different location. I'll keep that for the exam. I like the other practice exam similar to the. Units. Dividends. Now, dividends are the wacky ones, and again, we're kind of unmixing the cake here in that, these dividends, if you go back to our journal entries, the dividends reduce the investment. So we're going to reverse that out, and it will increase the investment enough to make it balance out to zero. Oops. Okay, so this is, let's see. We got purple. Okay, so we got CD, we need I, we need the income. And so we come up here and this is our I. It's got a credit, we're getting rid of it with a debit because we're gonna include all of this in our total over here. So we don't want to count the income twice. Look at green. And you'll notice that this, the 12,450, gosh, that 12,540. I'm okay. Oh, you know what I found out? I have uh, I actually have a blood clot in my eye that blurs stuff. And it's really weird because it does it, it'll shrink things. So they're actually, some of the numbers will look smaller, than they really are. And some things will, you see it. But anyway, so I'm getting, they're doing some injection thing to get rid of the blood clots on next Wednesday. But it's really strange because it's like changing the lens, so it makes everything look really small for a part of it, of my eye. It's kind of strange and then the rest of it's just blurry. But anyway, so sometimes I see things and or I see like a blurriness, like, and there's a thing that is called it's a really good documentary called the Perception Deception, which means that when your brain can't figure the eyesight out, a lot of times it'll fill in the blank. And you don't know what's happening. Your brain just says, if they can't see it, it'll fill it in. And so when you have, and when it comes up into, well, we should talk about what you need for like the CPA exam to remember stuff. I don't think I put that out there for you guys. I should do that. The CPA, how to memorize stuff for the CPA exam. But anyway, so sometimes you'll see people, they'll see a crime happen or something, and someone will say, "Oh, the car was, red." Someone else will say, "Oh, no, the car was green," and the car, and they're all being honest. You say, "Wait, somebody's lying." No, no, they're not. They're being honest because their brain probably filled in and said, "Look, I didn't, it didn't capture the car, but it filled in." When they remember it, it'll fill in. And if you've seen more red cars in your life, you're going to say it's red. If you see more green cars, you say it's green. It's very your eyesight is not as perfect, and I don't mean yours personally, but our eyesight is not as perfect as might seem. Okay, so we got the eyes, like my eyes that are not so good, and now we need the expenses, and the expense is going to be the same as this. Nope, not that. Nope, not that. Here, this. This is going to be the same thing we're going to do. So buildings, 13,200, 10 years. That's the same as this. Building. I shouldn't have done that. So 10 years divided by 10 years. So excess. $15,200. I did buy 10 years equals 1520. Excuse me. Okay, so this is what we're gonna plug in for our expenses. Now, you recall back here, why is this 1240? Because you remember that we put on our books the 13,860 minus the 1320, and that should come out to this. Let's check and make sure it does, since I'm a little bit rattled about what I did earlier. 860 minus that. 12,540. Okay, that's how we got that 12,540. Good. So again, it's just that 12,500, this is just their income, but we said I had to subtract out some of the depreciation of the excess assets. Okay, so this would be an additional expense. That is it's a building, right? So building would be a depreciation expense. 820. Excuse me. And let's make that screen, so red. Oh, don't do that. Oopsie daisy. Red, there we go. And we'll come down here, and this will actually decrease our building by okay. Stop it. I know I did it wrong. All right, let's just do this. E 1320. Okay, I think we're done, aren't we? Yeah, we got all Sadie. Okay, now for the fun part. Um, Equal. So we're gonna take the revenues and smash them together. We're gonna take the expenses, smash them together, and I'm going to put those in as a negative. Ooh, not yet. Now I'll put it as a negative. Just because the expenses are money going out. And you do the income statement, you'll generally see those as negatives. This is a credit for 12,540. We have a debit for 12,540, so this will be zero. And if we did it right, they should come out to be the same. Hey, it did, yay. And if you think about it, that 13,000 minus the 1,320, 13,860 minus the 1,320, put that in income. This is already in this total. The income there is already in this total, so it should be the same when we smash them together. And even though, we show the public, it'll look like this. Here's our total revenues, cost of goods sold, depreciation expense, whatever. These would be the consolidated totals, but we actually already had those in our income to begin with. So the income isn't going to change for us. Okay, now for this one down here, you can do the easy way is just to take all of their, just copy these numbers over. And, there's nothing wrong with doing that. And basically this, the beginning retained earnings gets taken out, the net income is taken out up here. Dividends are taken out, there wouldn't be anything left in this account. These would all three be zero and the total would be zero. So you just take the beginning, the parent company numbers over here. And the only thing I'm gonna do just to confuse people is to put in the negative for the dividends because that's money going out. And if you think about it, the only dividends that actually went out to people are these. No one on the outside got these dividends. These all went to us. Okay, so these two should be the same, and they are, actually, all of these should be the same. These are the same as those over there. And you say, well, can we just copy them? Yes, you can. Okay. Coming down here. Plus these two, plus debits, minus credits. So on the balance sheet, these will all be pluses. These will all be negatives. You can't see those. The invisible pluses and negatives. Oh, there you go. The negative is still pretty small though. Well, that's what he gets for being all negative. Okay, here we go. So I'm gonna copy this down. It's always good to take a example, kind of make sure that it's coming out. I'm gonna do the buildings just to make sure. 127.80. Yay. Okay, so these are more than likely okay. This one should come out to zero, and I really hope it does. Plus any debits, minus the credits. Yay. $566,940. Okay, coming down here, we got to take our liabilities and smash them together. Smash. Oops. Smash. Now, as far as the equity accounts themselves, these will be, only the parent companies will be left. Retained earnings is eliminated up here completely. These two are gone also. There's no outstanding stock out there. If you want stock in the, you can only buy the parent company stock. You can't buy this stock. So only the parent company stock is going to be left. And hopefully. Yep. So that is that. Why is that off? It's not off. What am I saying? is on. And this would, if you just add up these two and add it onto that, you should go to it. Yeah. Okay. So actually, these two are not off. They are what they are. Okay. Question on that? Here, you want to get a screenshot of that? Neat. I've been in meetings. It's so funny because I mean, like, you meet in front of a class. I have two classes that they do. But you're in front of a class like 20, 30 people. It's fine, I could do that all day, but you get in these meetings that are just exhausting. Okay. So let's go ahead and do this up here if you want to get a shot of the income statement and everything. Okay, any questions on that? Well, other than my mistakes on doing it, the only thing I gotta do is change this to consideration. I'm gonna try to make I'm gonna give you guys a choice of doing it in Word, on a PDF form, or in Excel, and I'm gonna put the journal entry ones in Excel also, if you wanna do them that way. But any way you wanna turn it in is fine with me. And you can always turn in two or three, if you want. So you can turn in all three of them if you want to do that, or just take pictures of it, or do it on notebook paper, however you want to turn it in. It's fine. Questions? All right. Well, it's a little early to take a break. Let's go ahead and take a break though. 6:48. Oh wait. Okay, so let's be back at yeah. 6:58. Let's just say 7. How about we say 7 p.m.? Be back at 7 p.m. And how come that didn't work? There we go. Okay. See you guys in 11 minutes. Yeah, extra minute. Excuse me. Okay, let's see here. So foreign currency translations. This is when we are translating a foreign company, usually a subsidiary, and we're um, we're bringing it into the U.S. Financial statement. Now, there's two ways it could come about. It could be that it is um, we were just trying to translate it, and it's not big enough to actually put on our books as a consolidated financial statement. If it's they generally have a certain size that they do for consolidated. However, it could also be that it is, we're actually going to try to consolidate it. So if we're going to consolidate it, we have to take it from whatever the foreign currency is and translate it into US dollars. And then we can, smash them together like we just did on, you know, on the previous one. For we have to get these numbers into US dollars before we can uh, consolidate them. If we're going to do a consolidation on a foreign subsidiary. So that's kind of what we're talking about here. Okay, so the two different methods that we have, one is that it is done in the US dollar is the is a foreign currency is a functional currency. So we're going to translate everything into US dollars. Usually this comes about when the subsidiary itself is translates everything into US dollars as soon as possible. The one down below is when we leave it in the foreign currency, we don't take it into our own account. We don't translate it into US dollars. So the first one is when we take them and translate them into US dollars immediately. Actually, the currency gets exchanged into US dollars. This one is where we just leave it in foreign currency and we just leave it in, whatever country it is, we leave the money over there. So if it's, Australian dollars, we leave it in Australian dollars. Wherever it is, we leave it in that currency. This is when they're automatically translated. So I say, well, okay, well, when do these happen? Well, a lot of times if you're dealing with a country, especially if they have inflation, high inflation rates, you'll oftentimes, it's not my glasses off. If they have high inflation rates, a lot of times you'll try to translate them into US currency, or if not US currency, some kind of currency that's more stable. Just because if you hold on to it, the longer you hold on to it, the less it's worth. A lot of countries don't have tax systems that is very effective. So a lot of times what they'll do is instead of making taxes and collecting taxes, they'll simply print more money. And once they do that, of course, you talk about inflation. Inflation goes up. So if you're dealing with those countries, the whole the whole trick is to get it into a more stable currency as quickly as you can. And so that happens sometimes. It could also just be too that it's just an operation that maybe you need the cash to keep the American part of the company going, or that you have reasons for wanting it in US dollars. Now, leaving it in the foreign currency has some advantages. And the advantages are that the tax rates are oftentimes different in other countries. And generally, you don't get taxed until you bring that into the United States. So if you leave it over there, you don't get taxed on it. So if you have money, I think it was Apple had literally a few $100 billion in euros because they had negotiated with the Irish government, and the Irish government said, if you come over here and if you build a plant here and you do all your European operations here, we won't tax you at all, zero taxes. Now, if they try to bring that money back into the United States, they get hit with US taxes, and US taxes are for whatever the difference is. So for instance, if a country is charging 8% and the United States is charging 20, when they bring that money back in the United States, you say, okay, you already paid 8% for the foreign country. Now you have to make up the other 12% and give it to the United States. So literally like Apple would have had to pay the full tax on it if they brought it to the United States. So there are some reasons why you want to keep it in the foreign currency, even if there is a problem sometimes with the inflation. If the inflation is 10%, but the tax rate is 30% or something like that, you may still leave it over there. Okay, so let's share my screen. How about? Let's go to Mark, share your screen. Okay. So the temporal rate, when you change it into US dollars, it's actually more difficult to do this, to change it into US dollars, because you have to go through historical rates for a lot of things. And you literally have to go back and see what the historical rate was 30 years ago if you had a piece of equipment that was 30 years old. Whereas if you keep it in the foreign currency, it says, okay, well, it's just the foreign currency, whatever the exchange rate. For the most part, they're current. There's a few historical ones in here, but for the most part, they are average during out the year or the current rate at the end of the year. Okay, so let's see what this let's go. Let's go to this one. Let's see here. This is oh, good. Yeah, let's do problem one. Problem one is the functional currency is British pounds, so this is not in US dollars. So the foreign currency is the British pound. Excuse me. Hold on a second. Okay. So which method are we going to use? If the functional currency is in
The foreign,
yep, so it's going to be the foreign currency method. Yep. So this is the method we're going to be using for this one. Okay. I'm going to copy this over because it's just so we're not flipping back and forth here. I think I made it. There's probably enough room there for it. Okay, let's go to maybe down here. It's a little bunched up, but let's see here. Well, let's get rid of the temporal one. We don't need that. I'll just hide that. And so, okay. Right, so cash is going to be at the current rate. Here's another quirky thing. I have this the way it's shown in the books, but I don't know why we put the income statement at the end, but they do. That's fine. Yeah, I'm gonna move it. Move the income statement up so we can see it. Okay. All right. Most of the stuff you'll see is at the average rate, although there will be some things that are at specific points in time, and those are things that we will have to use that specific rate at. So let's take a look at the revenues. So the exchange rate is going to be the average. So here's the overall average for exchange rate. Now, if you think about it, why do we use the average rate? Well, because you'll make some sales in January, February, March, blah, blah, blah. Throughout the year, you're going to make sales, right? Most likely. So the average rate makes sense to do it that way because it will, some of these will be made throughout the entire year. So the average rate is what we're going to use for most of these things here because we'll sell stuff during the year. That'll be the average rate. The gross profit will be average rate, blah, blah, blah. Okay. So let's go ahead and put that in. All right. So average rate for revenues. Most expenses, cost of goods sold, property, plant, equipment, everything. Okay, so pretty much everything is gonna be at that. There's gonna be one thing that's not. Okay, so, let's see here. Cost of goods, oh wait, I didn't do the math here. Let's do the math. 500,000 times that. I don't think we need the cents. You don't have to do this. I'm just wasting time, actually. All right, here we go. So 625 will be the revenues. Cost of goods sold will be 47. Now, you actually can do the exchange rate for the gross profit, but I'm gonna do it separately because on the other method, it could very well be different. Excuse me. Operating expenses. Same. Depreciation expense. Okay, now here's the wacky one. Gain on sale of equipment. Now, this was done not throughout the year. This is done on a specific date. So if it's done on a specific date, we will take that specific date and use that for. Let's make it that color, I guess. Reddish. Okay, so because this is on a specific date, we will use that for the exchange rate. That specific date, this wasn't sold throughout the year, it was sold on a specific date. And it was 122. Now this is a gain, so this will be a plus. Okay. I just did a stupid. Okay, don't do a stupid like I just did. We already stopped here for the gross profit. We just have to go down from the gross profit down here to the bottom. And maybe I should highlight that in a certain way. Let me get a color about. A turquoise color, whatever that is. Aqua. So you're gonna take the 137, these two are already subtracted to get the 137, and then 137 minus 78 minus 15 plus the 9 will come out to that. And we're gonna put that down here. Excuse me. Okay, so coming down here, stockholders' equity. They say retained earnings is gonna be a composite. Initially, it'll be a historic. In the end, it'll be a composite. I'll show you what I mean by that. Okay, so they started this operation on 1/1/2025, so they'll use whatever the historic rate was for the beginning inventory for that. This will be the last time we use the historic rate, though. 1/1/25, so it'll look like this up here. Let's give that a color. How about green? And again, that's because this was done on the first of the year. It's a spot in time. What did I just do? I did something. Oopsie daisy. We're gonna multiply that instead of me just putting it over there. Okay. So, okay. Dividends are paid on a specific date. They're declared on a specific date, so we will take that date, which is 9/1. And the hard part is coming up with a color for it. What have we used already? I don't think we didn't use purple yet, did we? Nope. Okay, so we will use purple for 9/1/2025. And we'll sum that up. Okay, now I want you to notice something here. When they talk about, composite rate, what does composite rate mean? A composite rate is when you have more than one rate. And actually, if you look up here, even the income statement, this is actually a composite rate because it has the 122 along with the 125s. There's more than one rate in here. This is actually a composite rate. This would be I don't know if it'll fit in here or not. I'll make it fit. Here we go. That's actually a composite rate. Same thing down here. This is the composite rate. It has, in the income, it has 125, it has 122, it has 130. This is a composite. It's got 126, so these have a bunch of different rates. And so this is why they say it's a composite. It has more than one rate. And yeah, just, even if this is the foreign currency method, but even in the foreign currency method, it's all different rates. Most of them are going to be average for your income statement and then current for year end, but yeah. So the first one will be historical, very first retained earnings. Going into the future, though, when you start looking at the beginning retained earnings, it's going to be a composite rate, and that's why this down here says, composite. Okay. Let's go to the balance sheet. Balance sheet. Yay, everything's current. So the current is actually the year end rate will be the current rate. I don't know why it's not called year end rate, but we call it the current rate. And who am I to judge? Okay, let's make it this orange. Okay, so everything is at 132. Oh wait, can't do that. No, I can do that. This one actually is not at a composite rate. Excuse me, that would be at a current rate. Okay. Let's go to liabilities. Hey, current rate, gotta like that. So I just did this wrong. This one is not, so it's not a liability at all. Wait, no, hold on, wait a second. I'm sorry, this one, the common stock will be at the historical rate, which is the original historical rate, which is that. Okay. There you go. Retained earnings. This be from up here. That this is this retained earnings. How about an arrow? We all love arrows. And of course, invisible blue, our favorite color. Oops. Okay, so this, that'll be that one. And we'll add this all up. Okay, so you'll notice something strange about our balance sheet. What is it?
Doesn't, so the total asset does not correspond with the total liability and equity, the amount.
Exactly. These two are not the same.
Yeah.
So the question is, do we have a gain or loss? Now, we have 640,000 in assets, excuse me. And we owe a total of 632,650. So we owe some of that to the owners, we owe some of it to our lenders. So we have 640 in assets, we owe 632. So the difference between those, they're gonna be a gain or a loss? We have more assets than liabilities.
Gain.
Gain, good. This would be a gain of 775. So this would be a translation gain. Let's go to. You know what? I think I'm gonna stop here. Let's stop here. Well, let me take a look at this. I got these kind of set up funny. Trying to see which way I have it set up. Now, here's my dilemma. let's put it to a vote. Here's my dilemma. I can either show you the other method at the same time, which might be confusing, or I can show you the same one, which might be boring to see the same one at the same time. Or I can wait until next week. So how many people want to see do another one like this? You put it in chat if you want. No one's voting, so whoever gets to chat first, you put in your vote. Nobody's voting. This is just like a real election. Nobody's voting. All right. Well, I'll make the decision myself then. I gotta save that. And we'll do one more. Let's go to problem 3. Problem 3 is a similar one. Functional currency is the British pound. So this is problem 3. And again, the method you, I didn't put that in on the other one. The method used is going to be the foreign currency method. Oops. Foreign currency method. Current rate method, sometimes called. Oops. Okay, so we're on number 3. So hey. Oh. I'm gonna put that in on the other one. Method used, foreign currency. Sometimes called the current method. Okay, and I'm gonna go ahead and copy this over. Okay, let's go ahead and do this one. A shockingly similar one. Oh, excuse me. What's gonna be the exchange rate for the revenues?
Can you share your screen again?
Oh. Yeah, that would probably make it easier for you guys. You don't have to use that holographic telepathy or whatever. Okay, so yeah, all right. These different numbers, are they got the same numbers? They look the same. No, they're not the same. Okay. So what are we going to use for the exchange rate for the revenues?
The $1.28.
Yep. We can use the average. Can't remember what color we made those, but it is that color. Let's see here. Okay. All right, so we're gonna go down the list here, and this will be. Now, truthfully, you could get away with it on this one to put the gross profit to actually just, because these two are the same, it could be, you can do that one. I'm gonna do it separately because on the other method, Yeah, you get in trouble doing that because you use a historical rate often for the cost of goods sold. Okay, all this other stuff is for the most part gonna be the same. Sorry about that. I said a sneezy fit. Okay. So these two will also be at the average rate. Now, this one was not done throughout the year. This one was only done at one point in time, so we'll use that as our. I forgot what color I made that last time, green. Hey, that doesn't even look right. What is that? I don't know. Okay, so this will be that one. 125. And that's gonna be a plus. I'm gonna cheat and see what color I made those blue. Okay. Oh, I can't make them blue. I already used blue. Darn it. Okay, we'll make them orange. It's so hard to keep these colors right. Ugh. Okay, so our net income would be 8668. All sixes and eights for both of them. An unhappy coincidence. Okay. And again, we're only going from the 225, 280 down because these two have already been. Uh, we'll be actually we'd be double counting that if we did it again. So anyway, this is yeah. Okay, so 86, that is going to be our income down here. Just gonna move that down. And again, that's already a composite rate because it's got more than one rate in there, so this is a composite. I'll tell you one of the crazy things about this. I'll have to check and make sure that the rules haven't changed yet, but if they change from one method to another, you literally have to go through all the years and reverse out the previous years and then put them in as the new. So for instance, if you go from the current rate method to, the temporal method, if you go from the foreign currency one, the temporal method, you would have to reverse out all of the entries throughout the years and then put them back in as the temporal method. It's really a hassle. I don't think they've actually changed that though. I think it's still the same. Okay. Retaining earnings. Now, these are going to be a composite rate after the first year, but the first year is going to be whatever you put them on the books for. And this is the first year. This is 1/1/25. So we're going to take the historical rate from 1/1/25, which is that. And we haven't used, how do we use red yet? Let's use red. We'll use red for the historical rate. Okay. Dividends declared, now this is gonna be a point in time. Hey, they're declared on Halloween, look at that. Pretty cool. All right, so this is on Halloween, we declared them purple. And so that will be Halloween purple. And add these up. And we get a sum, and now again, these are all composites. So when they say composite, you know, you say, what would I do with that? Well, you don't really do anything with that. That's just how they work out. You know, this 460,000, this has 128, it has 125, 133, 129, it has all different rates in there, so it's a composite rate. Okay, let's see here. Hey, I wonder if I can freeze the screens. I used to know how to do this. You know, you guys are thinking he's gonna goof this up. Hey, I didn't do it. I didn't screw, man, did you see that? I didn't mess it up like you guys thought. Or did I? Wait a minute. No, I think it's okay. All right, we'll leave it like that. Okay, so cash. Okay, you kind of screw. I gotta go back up for those. Okay, so these are all gonna be the current rate, which is the ending rate. Okay, so it's not perfect, you know, it's, you know, it is what it is. All right, so let's see here. This is purple. Do we use green? We did use green. Uh, I don't know. Let's see. Current. I gotta choose a color here. I know yellow. Just use plain old yellow. How about that? That's a good color. Can you guys see my screen?
Yes.
Yes.
Oh, there it is. Okay, never mind. Okay. All right. So actually, this one would not be a composite. This would be 135. The balance sheet for the assets, anyways. Okay, down here now. Let me try not to be goofy and do it wrong again. So these two will be at the current rate. And by the way, liabilities are virtually always at the current rate because if you wanted to pay them off today, that's what you have to use is the current rate at 12/31. Okay, historical rate. This would be the 133 at the beginning of the year. Retained earnings would be from the retained earnings up here. I can copy from one to the other. Let's see. Hey, look at that. I did two techie things that didn't blow up in my face. All right, so those two are the same. This is a composite. It'd be a composite anyways, because these are different. Okay, so this would be. Okay, let's see, the difference between those is, oops. Difference between those is, well, 80, gain or loss?
Gain.
Gain, good. So that would be a gain of 12,080. And by the way, this would be reported in comprehensive income, which would actually be this would be included in this in the equity section. So this would be comprehensive income. The comprehensive income is in the equity side. I don't have it broken out here, but the equity section would have this translation gain of 12,080. It does not go through the income statement. And it doesn't go through the income statement because it is not what they would call completing the cycle, and that it's still ongoing, whether this is going to be a gain or loss overall. And, you know, for the life of the thing, basically. So this will not be in the income statement. If you look at the information though over here, the US dollar or temporal method, it does go to the income statement because it is absolutely finished. It has been changed into US dollars and it will be shown as income or loss in US dollars on the United States, the financial statements made in US dollars. So the foreign currency one, we don't put it in as income. It actually goes in with the equity section to kind of hold it there. You can still see it. I mean, you can still go there and say, okay, you know, we know that they're holding it in the foreign currency, but do they have gain or loss on it? You can still go to the equity section and see it. It just does not get included in income up here. Freeze these panes. Okay. Any question on that? Okay, let's stop there. We'll do the temporal method. Temporal methods are a little bit more tricky. Wait a minute. File. Okay. Any questions on that? Do you guys want to get a picture of that? Or are you okay?
I'm okay, thank you.
Okay.
I'm good.
Okay. Well, let's. Oh. So I'll get out the let me get down to the tonight thing. Here we go. I'll email this out tomorrow. I might get it out tonight. I'll try to get it out tonight, but more than likely it'll be out tomorrow. And I want to do it in Word, PDF, and Excel for so that you can put it in either one or a combination of them. You know, if you want to put the one problem in one and one in the other, that's fine too. But anyways, I'll send those out and those will be out by tomorrow. And it'll be due. Friday. 2 dash. I think it's 28. Let me check. A week from this Friday. Yep, 2/28. So this will. Supposed to be due on. Okay. Any questions? All right, see you guys. I will see you next week and be looking in your email for the exam. It'll be out by tomorrow.
Okay, thank you, Professor.
Yeah.
And hope all goes well with your procedure.
Huh?
I hope all goes
Oh,
well with your
yeah. Thank
procedure.
Thank you.
All right.
I'll be able to see
Thank you,
things.
Professor. All right. Have a good night.
Have a good night.
All
Thank
right.
you.
Bye.
Bye.